is probably very contrary to majority of the people opinion. You know, if you look at CNBC and Bloomberg, a lot of people say we're going, you know, to 4%. You know, that's not my opinion. You know, I don't think we're going to 4%. I think actually the narrative is changing, right? The narrative is changing is that the inflation is not going to continue higher, that this is probably the top or very close to the top. The more likely scenario, we're going to have this kind of a head and shoulders, right? And eventually break through this level, right? Sometime, I don't know, sometime between September and October, right? The narrative is changing. Instead of this hyperinflation, Fed will raise interest rates end of July by 75 basis points, maybe 50, 75 basis in September. But, you know, once it gets close to this, you know, 3.2 or 3, then, you know, they will probably pause because, again, the new narrative is stagflation, right? That the only way to deal with high wages is, you know, you have to basically be able to let go people, have less job openings, and, you know, supply and demand, right? Otherwise, how else can you fight wage inflation? Commodity inflation is getting better, right? The oil prices, the lumber prices, the copper prices significantly pull back. But again, one thing, it could be ease of inflation, or the future, the economy will slow down. So my take is that the economy will slow down significantly, where interest rates will continue going lower and eventually break through this 2.7% and head lower. So I would pay attention to interest rates. Meanwhile, they're stable, right? They've been trading between 2.7 and 3.5, you know, since April. So, and that's what everybody wants. Nobody wants the yield to continue going, you know, to 5%. Nobody wants yield to go back to 1%. Both extremes shows this is, you know, recession, right? Stagflation, right? And this is hyperinflation. Both scenarios are not good words to use in a sentence. So you want to avoid recession, stagflation for the market. So as long as you have these head and shoulders or some kind of a box where interest rates are trading, then that's positive for the economy, yeah, for the market. Positive for the stock market. You do have yield inversion, which is usually indicates recession, right? 2-year yield and 5-year yield yields more than the 10-year yield for now several times this year. This has been actually for the past few days stubbornly. Usually it does indicate that there is the probability of recession is gradually increasing. The other headwind is a dollar, right? Continue to trade high. We did break through 105, which was a negative surprise, and got as high as almost 108. We're going back to 2002, right? So 20-year high dollar. We haven't even had it in 2008, nor in 2020, that level of stronger dollar, which is also bearish for the market. So the market internals basically is showing that, you know, that the market, you know, there's still more room to the downside than to the upside. Meanwhile, short-term market is oversold. You did see, even though of the hyperinflation and you know, better than expected unemployment numbers, right? More job creation. Initial reaction, spiders dropped the first, I don't know, an hour, first 45 minutes, significant drop, 1% on QQQ, and then revert. You know, by now it's actually turning slightly positive, right? The QQQ is flat, spiders up, ARC also up 2%, right? Significant down, up. So there is a lot of appetite for risk taking, right? And ARC innovation is actually breaking through this level and continues to go higher. So what does that mean? What's the interpretation? You know, a lot of people ask why these reversals occur. The best explanation I can tell, we are extremely, doesn't matter what indicators you use. You can use RSI, MACD, you can use artificial intelligence. You know, the idea is that if you look at the 6 months predictions for spiders, right, support is at 10-day, let's see, 6 months. Sorry. Right, we reached 360 level. Model basically saying at 360, the stock market is extremely oversold. 413. it's possible that we can reach 413. We're at 390, so we're 30 points higher, 23 points lower, probably sitting somewhere in the middle of the range, right? So short-term market is oversold, and I think it will continue going higher. I agree with the model. I think core scenario is 413, right? That we get to 413 level. Obviously, market can overshoot on the upside, just like it overshot on the downside. On the downside, it overshot last 2 months by 5%. Model says 410, 5% would be 430. Fine, I would not, we always argue with John, who's going to eat their keyboard. I would probably not eat my keyboard if we reach 430. Unlikely scenario, maybe 20% chance, right? That the pendulum will overshoot to 430. I would say maybe 20% it gets here, right? 420, maybe 50% chance it gets here. And more likely, July low. February low, right? 409, 70% chance, right? Not chance, my confidence level based on the market internals. Because we did have negative news, unemployment numbers, manufacturing index. It seems like no matter what the news are, and the trend has changed, right? We're posting higher lows, right? So these double bottoms are usually a good indication that that the next leg is up, right? Sometimes it doesn't hold, right? But in both cases, when you do have double bottom, especially if the second leg is higher, then you do have a neckline. You do want to break through this 393. That's the level of overhead resistance right now. But high, 70% probability it goes higher. 30% probability we retest the lows, right? And the main unknown right now, we're past the unemployment rate. The next level of data is the CPI data, right? Core CPI data. Wednesday, Thursday, that will spark the volatility, right? Two scenarios, right? There's only 2 scenarios possible, right? One scenario is this, right? The other scenario next week is this. Basically repeat of the similar setup we had in June, right? In June was a similar setup. I said 380 is the bottom. The conversation almost was identical. 380, it was extremely oversold. We did bounce all the way to 410. I said, as long as CPI is the same or better, market continues to go higher, probably gets to 430, 440 level, right? That was the conversation in June. It's the same conversation right now. If CPI data, right, we kind of learned on the past 2 CPI data, if CPI data is worse than expected, right? It was, I think, expected 8.3 last month. It was 8.6. Now, I don't know what the expectation is, doesn't say, but I think it's around 8.3. If again, it's going to be, I don't know, 9% year over year, right? And months over months, it's going to be, 0.6 or 0.9. Then most likely, then you have scenario 2, right? If inflation is within the expectation or slightly better, then you have, scenario number 1, right? So both scenarios possible. I'm an internal optimist. I don't really know will CPI going to be better or not, but I always think status quo at least or better. Status quo or better, we're going higher. Obviously, if it's worse than expected, then we're going lower. No model can predict the outcome. The model actually right now does show that bulls are in control, right? The bulls are in control. If we do 10-day prediction on spiders, model actually neutral on spiders. QQQ, let's see, is it still positive? QQQ is much stronger, right? So technology has been outperforming, on lower interest rate, technology has been outperforming spiders. So the model basically saying going into today's unemployment number, going into the CPI and PPI print next week, the path of least resistance is to continue going higher, right? Bulls are in control short term. Bulls are in control short term. and potentially can reach one of these levels. So for traders, it's important to also have an opinion, right? So you have different scenarios, right? The first question, everybody, you turn on CNBC and Bloomberg, there's only one conversation: is this the bottom, right? We did this on Yellow Tunnel platform yesterday. That's the question number one, right, that you need to answer, right? If you're a short-term trader or if you are a long-term investor, right, it doesn't really matter, because my friends are, say, well, I don't really, I have a full-time job, I don't really follow the market, I have money in 401k, what should I do? And then the answer is, do you think this is the bottom, right? Because if you think this is the bottom, you probably want to start, or close. It doesn't have to be the bottom, right? It could be close to the bottom, even if it's within 10%. If this is within 10% of the bottom, and you're a long-term investor, then you should probably start buying, maybe aggressively, right? If you don't think this is the bottom or even close to the bottom, then you probably want to hold off.